We are running exactly on time. It is 1 o'clock and we shall begin our second session on mega funds in venture capital. With us today we have Anirudh Garg from BEENEXT India. We have Dan Kimerling from Deciens Capital. We have Jeff Weinstein from FJ Labs and Ashley Lewis from DPI, because you only deliver DPI, not
exactly.
IRR. And I'm Ben Kasnoka from Village Global. There's a dynamic on our industry of venture of some very large funds being raised, and that is distorting the ecosystem a little bit. And we're going to have a bit of a debate. So the FII folks this year have conceived this new format, which is interesting. So we're all standing like it's a presidential debate, just as consequential as a presidential debate.
Maybe more consequential.
Yeah, a lot of things are going to change based on what happens in this session. And we're going to create some premises, and there's going to be just visceral disagreement, and just I'll have to restrain people, physically separate, because people are going to debate and disagree. And we're going to talk about the pro and con of mega funds, and then we'll have a bit of a discussion on what happens next in our industry, because we are in a very fascinating moment, which is last year, 2 venture firms, Andreessen Horowitz and General Catalyst, raised something like 70% of all LP dollars that went into our asset class. That's pretty extraordinary, and we'll discuss and debate the pros and cons of that. So in our first round, we're going to ask the question, does capital concentration in mega funds slow innovation, or do the existence of these scaled up venture firms actually accelerate venture formation? Put differently, is like Andreessen Horowitz a force for good or a force for bad in our industry, as probably the single largest VC firm right now in America with over 40 billion AUM. So to start, we're going to have Dan Kimerling talk about small funds and why there might be some problems with the mega funds in our industry. And then Jeff Weinstein, who himself runs a multi-billion-dollar franchise. No, I'm sorry. But for purposes of today, he's Jeff Andreessen Horowitz Weinstein. So Dan, make the case for why small funds are great and why we should be nervous about the mega funds over scale.
Well, I think, one, thank you, Ben. Thank you, FII. We all really appreciate the opportunity to be here. I think it really comes down to the basic problem of incentives. If you are a $40 billion platform clipping 3% fees a year, do you really have any incentive to do anything other than to keep the fee gravy train rolling? I don't know about anybody else, but I'm still working for the carry. The carry is what ultimately aligns everybody in our ecosystem, the GPs, the LPs, and the entrepreneurs. So I think that's really the heart of it. The other question is, can large funds really do the job of delivering the returns that LPs need to meet their liabilities, their obligations? And I think it really comes down to how big can these outcomes really be, how frequent are those outcomes. For the audience, the largest venture-backed M&A ever was Wiz, $32 billion. It's not closed yet, but it's been announced. Google acquisition for $32 billion. That's the largest ever. That won't return several large venture capital funds.
And I think that was shown in the Wiz transaction.
Oh, yes.
Insight Partners and Index both invested in Wiz out of like $2 billion funds.
It won't return them.
It didn't. Wiz, the biggest transaction ever, did not return Index or Insights funds.
So at Deciens, we call this heroic assumptions versus heroic outcomes. Most of the math for these venture funds requires heroic assumptions, like multiple Wizes, multiple Figmas, for every year outcomes. And there's just there's no empirical validation for those kinds of outcomes.
Do you think there'll be, because this is a central debate in Silicon Valley today, smart people disagree, there's no right answer necessarily, but do you think there'll be an accelerating number of mega outcomes? Because I think that's basically the A16Z pitch to LPs, is there'll be more Stripes, more SpaceXs in the future, because AI is changing everything, so we can count on an accelerating number, and that's what justifies the fund size. Do you buy that?
There may be more large outcomes, but it's not actually large outcomes that they need. it's large capital efficient outcomes.
Yeah.
So some of you might have seen in the paper, the multiple of invested capital for somebody who invested in the seed round of OpenAI is 25x. That's not good enough. Like, we need hyper-convexity in our portfolios to justify the illiquidity, the fees, the carry, all the bullshit that we extract and exploit from venture capital as venture capitalists. And so, like, 25x just doesn't cut the mustard.
So then just to make sure we underscore the point on misalignment, because at dinner yesterday I was talking to somebody who's invested a lot in venture in these big funds, and they said, the misalignment between GPs and LPs really annoys him, and it's because if the GP can legitimately get rich off fees, then in theory they're not going to focus as much on making good investment decisions.
The math would suggest that they should do 1 basis point better than the minimum hurdle rate they need to keep going.
Yeah.
And not anywhere. In baseball, if any of you are baseball fans, there's this idea of the Mendoza line. The Mendoza line is the worst batting average you need to get your contract renewed. They just need to be above the Mendoza line.
Yeah. Yeah, I think Andreessen Horowitz does over $100 million a year in annual revenue. That actually makes it a more compelling. Andreessen generates more revenue than HubSpot, in ARR. It's an incredible ARR business. Some of these asset managers at scale can be incredible cash flow businesses.
I mean, we should just buy Blackstone stock at that point.
Yeah, exactly, yeah. So Jeff, you spend your life at these big firms. No, Jeff actually is at a nimble, excellent small firm. But for purposes of today, tell us why these super scaled mega funds could actually be good for innovation and venture capital.
Well, as a spiritual mega fund myself.
Yeah, exactly. 10 years, it will be a mega fund. So.
Yeah, exactly.
Yeah.
Now, it's interesting. You guys talk about some of these outcomes. There's an omission of a pretty notable one that recently raised at north of $100 billion, of which Andreessen owns, I believe, 10%. It's called Databricks, okay? It is a fact that startups are becoming larger than ever. It is also a fact that more capital can be put to work in the ecosystem than ever before. It's also a fact that, in my opinion, there's nothing inherently good nor bad about funds getting bigger. It's just that they have LPs with a lower cost of capital. And so if gigantic pension funds and sovereign wealth funds only need, call it 9%, 10% IRRs, then so be it, that's fine. And I don't believe actually there's much of a correlation between the amount of capital beyond some level and innovation. I think that all you have to do is see what Elon has done with some of his companies with minimal capital raised to understand that it's actually the talent density and it's the urgency at which they work that is the constraining factor.
Okay, so if we I don't know how much went into venture last year. Does anyone know offhand? But let's just say that number goes up by 20%. You're saying innovation in America or the world is not going to go up by 20%. Like, capital's not the issue. Is that your point?
Yes, absolutely.
Okay.
And look, the truth is actually, I do believe that large amounts of capital can distort and can be damaging.
Right.
But you're also seeing examples. I mean, you look at some of these AI companies and what's happening, and they're absorbing unprecedented amounts of capital. And it's not evident to me, based on the history of OpenAI so far, or Anthropic, that these billions of dollars are slowing innovation. In fact, they're unlocking more innovation. And so the fact that these companies exist, they're growing faster than ever before, they're more global than ever before, exits are larger than before. I think it's fantastic that funds are raising more.
I guess just a slight counter or a nuance might be that when OpenAI and Anthropic can pay their engineers tens of millions of dollars, that makes it hard for startups to compete for that talent. And so arguably, big tech, now we have these $5 trillion businesses, it's hard for startups to recruit against NVIDIA for great talent. And if you believe the innovation of the future is going to come from startups more than big companies, that is a bit of a problem. Now, NVIDIA is a public company, but Databricks would be a better example of a privately held company that they can inhale cash so easily from the venture market and then turn around and pay engineers a fortune is distorting the talent market in the Valley a little bit for startups. What do you think?
If that was the case, you would see it play out in lower and less impressive startup formation. That's just not what we're seeing. We're seeing amazing startups being created. In fact, a lot of these liquidity events allow for people to become angels themselves. The ecosystem continues the flywheel to spin. And so it's not what I'm seeing on the ground.
I think there's a bit of a confusion. It's not the size of the venture fund that is inherently problematic. It's the incentives that the size creates. Like, I genuinely believe that our problem is not capital, it's the courage to deploy it in new and novel ways. Like, venture capitalists are lemmings. We don't do non-consensus shit anymore. We actually just plow money into consensus shit.
Do you think VCs are more lemmings than any other industry? Like, most people are sheep in their life, right? They just follow the conventional wisdom. Are VCs especially that way, or just the societal norm?
They're especially that way because most venture capitalists will never see a dollar of carry. So their job is just to put dollars to work so they can get another job at another firm 3 years later. Would you disagree with that assessment?
Well, it's definitely true. Average returns in our asset class are terrible.
Yes, sir.
So that's why if you're an LP thinking about allocating to venture, you only want to be in the best funds. But the average return is bad. So you're right. Most funds are going to be terribly performing. Then the extraordinary funds can deliver truly extraordinary returns. Anirudh, do you want to jump in on any of this?
I think the way I look at some of these platforms is I don't think they're VC funds anymore. These are asset managers. So again, the way you sell this product to LPs and investors has to be different. So I don't fully agree that these people cannot make returns, but the way you have to promise returns will be different. So they will be a platform to build businesses. So a lot of the fund managers are now becoming RIAs, they're opening wealth firms. So I think this is one way to build capital pools, but I think they're competing with the Blackstone now, not with a lot of the VC funds.
Yeah, and to Jeff's point, there's nothing wrong with Blackstone, and if you're an LP looking for a relatively low-risk way to deploy capital, it could be totally fine to invest in GC's latest $3 billion fund.
By the way, what you're seeing is the natural progression, the professionalization and the institutionalization of the asset class. More capital comes in, returns go down, and that's fine.
Yeah.
I mean, as a spiritual mega fund, but maybe a boutique niche asset manager, I don't love it, but frankly, that's because it's more competition. It makes my job harder, but I give them all the respect that they deserve and that they've earned. And the reason they can raise this much is because of fantastic performance, and so that's fine.
So let's shift, and Ashley, we'll bring you into the conversation to talk about multi-stage funds and these mega funds investing at early stage. Do you do mostly early stage investing at DPI?
So we do everything from pre-seed to pre-IPO in our market.
Pre-seed to pre-IPO.
Exactly.
And you're doing this in like emerging markets?
We're doing it specifically in the Africa region. So
in the Africa
we've
region.
deployed and managed over $3 billion, reaching over 40 African countries. And what I heard so far today is it's very US-centric, but we're actually missing where a lot of the global talent is coming from and also consumers are coming from, which are these large emerging markets. For us at DPI, we spent 15 years specifically in private equity, but in our space, we were able to invest in a lot of tech-driven companies that led us to launch a venture capital fund and now manage the largest fintech fund in the region. And so I see a place for I dare to call ourselves a mega platform, but for our region,
$3 billion AUM.
Yeah.
You know.
I mean, you can be a spiritual mega fund.
You're a spiritual small fund,
Yeah.
but in practice you're a mega fund.
Exactly.
Yeah. Yeah. So do you see? So this is a little bit of an inside baseball topic. You know, hopefully people are interested in this, but it's the kind of stuff that keeps life interesting to us. Mega funds engage at the early stage, increasingly for deal flow purposes. Andreessen, Sequoia, Lightspeed, Founders Fund, whatever, all doing seed investing, and that is creating a set of problems in some people's opinions around signaling risk in later stage rounds, and driving up prices for seed VCs like ourselves. What are you seeing in Africa? Are these mega platforms coming in at the early stage, or is the early stage left for early stage specialists, and the mega funds are only playing late stage rounds in Africa?
So what we've seen is around 2020, 2021, we saw a lot of those mega platforms, global mega platforms, come into the Africa region and then quickly wash back out. And that left a massive white space for players like ourselves to be the partner of choice for larger platforms that do want to come in and have still appetite for the Africa region, but also for us to be able to play up and down that spectrum from pre-seed to pre-IPO. And so we can do everything from lead, co-lead, but I do think that there's still a special place for smaller funds to be able to scout, provide local context to mega platforms and co-invest responsibly.
And just while we're on the Africa topic, like what's something a lot of people believe about Africa venture that just ain't true?
Oh.
Like what's a common misconception?
I mean, the common misconception, just point blank, is that you won't be able to find returns or great great founders there, but that's just not the reality. We've been able to become a top quartile fund just by focusing on one region and improving returns.
And the Africa market you're most bullish on is which?
Egypt.
Egypt.
So, yes. So for context, we run, and I want to share this because when we think about mega platforms, we talk about the LP perspective as well. Our funds have 100% commercial LPs. 95% of that capital is from Africa. So there are African investors backing African founders, and where we're seeing Egypt placed in the market is a great nexus into the GCC, but also expansion opportunities into sub-Saharan Africa.
All right, that's a new thought. That's interesting. So coming back a little bit to the inside baseball question of our mega funds screwing up the seed market by driving prices up and creating signaling risk for founders trying to raise subsequent rounds. What do you two see in this regard? When you have a company that is picking between, General Catalyst and Encore Capital, to pick a firm that we all know and respect on seed, would you advise them to take the seed specialist money because of the signaling risk of the mega fund, or are the platform resources and brand power of the mega fund worth something to that founder? What do you guys think?
Maybe I can go first, yeah. So we generally believe that seed should be left to seed funds because just our incentives are so aligned to service the founder, because it's also a servicing business apart from just investing capital. So a $2 million check for us is our core position. Versus a $2 million check is a core position for us. So we'll put everything we have in terms of resources and time to make it work. Versus for a lot of funds, it's just like an optionality value. So I always advise founders to not have optionality value with their cap table. And always it's good to have the bigger funds be hungry and come in and lead your next round. So we generally push seed funds to lead the seed rounds.
Dan?
I think that ultimately building a company is a very lonely experience. It's a very isolating experience. And what most entrepreneurs are looking for is a true partner who will roll up their sleeves and be a co-builder. We describe this as the third co-founder. And I think that you can find that at the big funds, but the incentives are generally against you. Versus at more seed stage boutiques, we have to make it work. We are there with them. So I think that if you can get a mega fund to commit to having the right relational dynamic, contractually commit and deliver on that commitment, it can work, but I've seen it not work more often than not, and that would be how I would talk about anybody.
And Jeff, I'll be curious, it strikes me that if you're building a business in a super capital intensive category, like deep tech, hard tech, the deep pockets of the mega fund can be compelling.
Yes.
Because groups like Andreessen with their American Dynamism initiative are not afraid to plow tens of millions of dollars into super capital-intensive manufacturing businesses. If you're building a lightweight fintech business or even an AI application company where you can get to $10 million of ARR, only raising $10 million of venture, you're probably better off working with a seed specialist, knowing that their career and pocketbook depend upon your success.
Yeah.
And this was most illustrated to me when I saw a partner at a very large multi-stage firm tweet out that they hadn't done a single deal all year. I think it was like May, and they were making the point of, we're so selective, we haven't done any deals. And I read the tweet, I'm pretty sure they've done like 2 companies that we're invested in, so how could this be? And I went and asked some questions, and it turned out that a deal only counts if it's a $50 million check or higher. Yeah. None of the early stage stuff of small checks count as a deal in his psychology, which I thought was very revealing about how important you are in their own minds about when they write a small check at seed.
No human wants to be treated like optionality. It's a very toxic way to be treated.
Yeah.
I think we've all been in those moments where people just think like, I don't really give a shit about this guy. And the problem with the mega funds is they're structurally unable to treat small tickets as anything other than option value.
Yeah. I guess the equivalent at an event would be you're talking to someone and they're always scanning their horizon for the next better person to talk to.
Of course.
That's kind of the dynamic.
If I may take the other side.
Yeah. So from the mega fund perspective.
From the mega fund perspective, when you hear capital intensity, you should hear dilution, okay? And so I have an anecdote. A friend of mine is a VC in Latin America, and he was just telling me that he offered a term sheet for a $1.5 million round at $15 million valuation, 10%
15 or
dilution.
50?
1.5 at 15, 10% dilution, which is already a very rich pre-seed round. A tier 1 fund came in and said, listen, we love what you're doing. Why don't we do the following? Let's give you 3 at 30. That fund can still put in 1.5. We come in alongside them, same amount of dilution, double the valuation. What happened? They took that. And in fact, the risk with taking a high valuation is that you're just raising the bar. And it's that much harder to clear that bar and get the lift to raise your next round. But the most exceptional entrepreneurs are going to make it happen. And so would you rather take the 10% dilution for $3 million with the tier 1 and the local fund, or the 1.5 with the local fund? Option seems clear to me.
Ashley, were you going to say something?
I was going to say something. We were talking only about capital, but I also think geographical expertise is very important as well, and helping companies expand into new markets, having partners that have deep relationships in those markets, regulatory expertise as well, that can help de-risk the business. And I think mega platforms probably do that the best.
Yeah, that's true. That is an argument. The global network of certain firms can be helpful for globally ambitious entrepreneurs. Yeah. And obviously at BEENEXT, you have a great Asia network in India and Japan. So that will be an advantage. I do think these Jeff, your round size point is a good one. There's no human in the world that can resist the temptation to spend money if they have money. So one of the great lies that founders tell themselves, in my opinion, is, oh, I decided to raise 20 million, not 10, but it's okay, I'm never gonna touch it, I'm not gonna do anything different. Like, inevitably you run your business differently when you've raised more money than you need. You spend money less efficiently. And so I think it's, one of the ways that mega funds are, people like Jeff are screwing up our ecosystem, is they're injecting growth hormones.
Ben, I believe a friend of yours coined the term blitzscaling. I don't know.
Well, there are certain companies, very selective companies, that have such product market fit that the faster they can inhale money, capital can be a weapon. The problem with how people interpret blitzscaling is many more people think they fit in that very special category than they actually do. And so that it was a problem during ZERP as people raised, Masa and others sort of created this culture of, oh, just raise 2x what you think you need because you can run faster, but that wasn't actually an efficient business model.
Well, I think part of it is that above a certain growth rate, you add other risks, operational risk, team risk, and so on and so forth. I would rather a company only grow 5x this year than, and not take dilution than reach for the 10x, knowing that it will cause all other kinds of unintended byproducts and consequences.
So let's look out into the future and make some predictions. Like in over the next 5 to 10 years, do we think GC and Andreessen, et cetera, will continue to grow? Will they be public companies? Will Andreessen's AUM get to 50, 60, 70 billion AUM? And so will the mega funds continue to scale? Like, have they reached their terminal endpoint, or is there still more scaling to do? And what predictions would we have around the market dynamics? Is anything going to change? As Andreessen goes to 80 billion AUM, is that going to make it better for the seed funds because Andreessen will be even less competitive? Yeah. Or do you imagine kind of the current competitive intensity continuing at its current rate? Who wants to take a step?
Maybe I can start.
Yeah.
So I think one thing we are seeing is a lot of the US franchises want to go global now because they've heavily been focused on the US market. Like
US venture firms or
US venture firms. Let's say GC just acquired a fund in Berlin. They acquired a fund in India. So that's the way that they want to grow global. Yeah. And that's how they are justifying that they want to raise more capital so that they can go global and sort of build businesses in emerging markets as well. So I think that trend is going to be a lot more. I'm already hearing other firms approaching fund managers in India to acquire and sort of build a local franchise and sort of fundraise for them. So they will become platform enablers for different people to build businesses globally and across sectors, across asset classes. So that's my guess.
Okay, so the mega funds will continue to acquire global firms, and there'll be basically more M&A and venture, which is interesting, rolling up existing firms. That's an interesting prediction.
I would broadly agree. There are too many subscale venture capital funds. Like in other asset classes, to Jeff's point about professionalization, like there are pod shops. Like you would imagine that some venture funds should become pod shops with shared distribution, compliant, shared resources on the back and middle office, and then let different pods run different strategies on the front office.
And that's with both BEENEXT and Village. We've also done fund-to-fund strategies And I do think the natural evolution of a fund-of-fund strategy is a more integrated pod shop.
Correct. It's also more efficient to not go and fundraise 50 times a year as different funds, but you combine resources and you do what you're best at and sort of enable other people to lead the strategies they like.
Yeah, you see this most in IR, where everyone recreates the same IR CRMs and go to the same conferences. It'd be much more efficient if they could plug into a power grid of sorts.
Well, and this has happened, I think about General Atlantic buying Actis, and these mega private equity platforms are buying products to combine them, so there are more economies of scale and scope.
Yeah, predictions from the two of you?
I couldn't agree more. We just completed a fund acquisition in Africa, one of the first of its kind, and that allowed us to actually achieve scale, have the middle and back office fully operational from the back, and then allowed the team to actually focus on finding the best
And
companies.
were you choosing, did you first try to recruit the GPs to join your firm, and then they said no, then you had to acquire, and you bought the management company? Or
Yeah, it was a little bit of a unique situation, but we
Okay.
took over as advisor of the fund, and then we set up a new leadership team and hired a new team to manage it.
Yeah, the industry ventures Goldman transaction was pretty interesting.
Yes,
Absolutely.
Jeff, predictions?
I would echo what Dan said, and I would elaborate. There is a Cambrian explosion of venture fund creation in the ZERP era. There are far too many funds. About half of the funds that exist are dead or dying. Look for more M&A, look for lots of zombie funds. The rise of the venture pod shop. I already know someone starting a venture pod shop. Look for IPO. Andreessen and or GC will IPO, and look for more and more product lines. So GC has the customer value fund where they're basically doing lending. They're doing revenue-based financing. Andreessen has the family office. GC just made an offer on a large company.
On Janus.
Yeah,
They
on
put a
Janus
7.2
Henderson. There you
bid.
go.
This week they put a bid for $7.2 billion to buy Janus funds. It was in Axios. Like, I can't make this shit up.
And by the way, Dan Kimerling said he's going to be the next Blackstone, so look for him to become a mega fund as well.
Yeah, Dan, can you commit to everyone in this room today that you will not scale to become a mega fund? Will you make that promise to the American people?
Certainly,
can you
certainly I
acquire
won't
us?
scale
Making
my
the argument on behalf of the boutique manager, Dan, can you commit that?
Certainly I
Promise
won't.
us today that you will never become part of the problem.
I can commit to being part of the solution.
I guess in close, Anirudh does a lot in Asia. You obviously do a lot in Africa. The three of us mostly invest in the U.S. Oh no, actually, FJ
We do.
Does,
We actually
FJ
do.
does a
We're
lot
very
in
global.
LATAM, yeah, so actually it's a pretty global group. You mentioned Egypt as a market that's non-obvious and compelling. Since many of us have global perspectives, what are other either geographic markets or categories that might be underrated that we should all be paying more attention to?
Asset managers. We should be funding other asset managers.
Yeah.
So
I love it.
Invest in asset managers is an investment opportunity.
Fuck yeah, it is.
Yeah.
I love it. We've done a couple of GP investments in asset managers. I think there's also an opportunity that a friend of mine, I don't know if it's public, is looking to roll up zombie funds. And so I think that's an amazing idea.
So, but when you invest in GPs, I assume then you want them to scale AUM and just grow the fee stream, right?
Well, no, I'm the guy who's buying zombie funds.
Oh, you're buying the zombie.
I didn't know if it was public. So.
Yeah, I'm buying zombie funds. So.
Okay. Oh, I see. Okay.
Yeah.
What's a thing that what's a market in the world or a category that FJ is seeing that's non-obvious?
Okay, this is both very obvious and non-obvious. It's obvious in the sense that it's in the news, but it's not obvious in the sense that no one's doing it. I am super bullish in Argentina. We've actually, our two highest multiple exits were in Argentina. I am very bullish on the talent there. We've built tech teams remotely there. And venture funds are still too scared. And frankly, we're a little too scared as well. But we are looking there actively, and I do think you're going to see some more amazing companies coming from there.
And I guess Milei's political fortune is good news for...
Yeah, I mean, a couple more years of liberalization reforms, I think that you're going to see some really interesting things there.
Okay, and what about you guys? What's a non-obvious?
So one thing we are spending time on is global capability centers. So
Global what?
global capability centers.
Okay.
So it's basically a lot of the global firms want to set up their engineering offices in India, which is not only engineering but also goes into finance, legal services, etc. And India will be the powerhouse when it comes to talent for professional services. So we want to back firms that can build, operate, transfer businesses where they can help global firms set up offices in India and sort of run it for them.
So how bullish are you on India versus Southeast Asia?
I think I'm biased. Obviously, we do a lot more in India, but the exit markets in India is really doing well now. Like the public markets have been really powerful. I think that's the missing piece in Southeast Asia yet. And also the talent pools are much deeper in India. So
Yeah.
we're very bullish on India.
Okay. You're mostly US, right, Dan?
90%.
Are there then, for you, Dan, are there categories of businesses or themes? You said asset managers. Any others that you'd highlight as, like everyone knows AI investing is compelling, but what's a non-obvious category or AI implementation that maybe more investors should pay attention to?
Well, we have an AI business in the construction vertical, which is doing great.
Yeah.
And I think one observation I've seen is that top-down AI deployments are not working super well. Maybe Sierra is doing pretty well, but like most top-down AI deployments.
Sierra's selling contracts. I'm not sure what the utilization is by the customers, to be fair. But
Right.
Keep
But AI lets you go after the smallest customers in super capital efficient ways. So I think you're going to see more bottoms-up go-to-market motions in this AI first era.
Got it. So the top-down implementations are the CIO of some organization's been told by the CEO they need to buy AI. They implement something, no one uses it. The bottoms-up are where employees are adopting tools on their own and bringing them into the organization, right?
Right, because it's creating net new capacity for that micro enterprise.
Yeah. So PLG bottoms-up AI adoption is the wave of the future. Ashley, what beyond Egypt are there categories, other geos, themes that you think are underrated right now?
So two things. I'm still extremely biased, and I've spent the last decade focused on financial inclusion and fintech, and I still think that there's an opportunity for that in the Africa region. But I think we're changing our lens in which we're looking at it through, from financial inclusion more to financial prosperity. So sometimes the statistics around, for example, insurance penetration, we're still at sub 1% across the region.
What penetration? Insurance?
Insurance penetration.
Sub 1% of people in Africa have insurance?
Exactly. Yeah. So one of the deals that we just completed was a Senegalese AI health tech business that's really turning insurance on its head. And the sub-vertical that you asked about, I think companies like Senegal that have a lot of currency stability are extremely interesting.
Countries like Senegal. Okay, interesting. And do you think like Kenya is overrated as an ecosystem, overfunded?
Yeah, so off the record, I'm very...
Okay, all the cameras you're now off the record.
Perfect. I think there's two markets that I'm a little bit hesitant on. One that I live in Lagos, Nigeria. It was the #1 kind of VC ecosystem for some time. I still see some challenges there, but we are deploying. And then Kenya, I'm not bullish at all, really, on it. I don't even spend much time focusing on the country.
Jeff, are you buying Bitcoin, holding, or selling?
I think I'm the world's worst crypto trader. I've been investing in Bitcoin since 2013, and I'm down. So I don't think I should opine on this subject.
And Dan, what about you? You do a lot of financial services investing, crypto, blockchain. What's your prognosis?
I'm longer on gold than I am on crypto.
You're longer on gold than crypto?
Yeah, because I think that elliptic curve cryptography is kind of nearing the end of its life with quantum, and that will post-quantum crypto is like very nascent, technically.
Sorry, post-quantum crypto is what?
The next generation of Bitcoin that's hardened against quantum attacks.
Quantum, yeah. Okay, interesting. All right, well, thank you all very much for being part of this. I think you guys almost started brawling, but you demonstrated great professionalism and restraint. Everyone's healthy, and I think we all agree that mega funds are no good. People should focus on seed funds and seed specialists. They are the future of innovation, except if you're a mega fund in Africa, it's a good thing. So thank you all for the time.
Thank you.
Thank you so much.